Good morning, and thank you for letting us share some of your time this morning with us. I'm Miao. I'm the Senior Investment Strategist at Churchill Asset Management. And with me is Ken Kencel, who is the founder, CEO, and president of Churchill Asset Management. Ken brings over 30 years of experience in the private debt middle market space, having invested through multiple credit cycles. And so for the next 15 minutes, Ken and I would like to share with you our thoughts on the U.S. middle market, some of the opportunities that we see, and a little bit about our firm. As background, Nuveen is the asset management arm of TIAA, and Nuveen currently manages approximately $1.2 trillion of AUM, of which $65 billion is in private capital assets. For the last 6 years, Churchill has been part of Nuveen as the sole exclusive provider of private credit solutions to Nuveen and its investors. And currently, Churchill manages over $30 billion. And so why don't we start, Ken, with you telling us a little bit about Churchill and the business and what you see and how it fits into Nuveen.
Thanks, Gene, and thank you all for joining us this morning. Delighted to be here with you and talk about private capital with investors. You're absolutely right. Churchill is the exclusive provider of private capital to middle market companies in the United States. We focus exclusively on providing that capital to private equity owned companies. So it's a very focused business. We manage over $30 billion of committed capital today. About 2/3 of that is managed on behalf of TIAA, our largest investor. In fact, TIAA is the largest investor in private debt globally, with about $75 billion committed to private credit investment, actually 3 times the size of the next largest investor. So it's very helpful to have such a large and important client. About 1/3 of our assets, or about $10 billion, are managed on behalf of over 200 institutional investors globally. Obviously, we have many investors in both Asia, Europe, and in the United States. And we invest for them in private credit across the spectrum. We provide both senior lending and our core senior lending team, but we also have a team that manages our junior capital, private equity co-investments, and our private equity fund commitments. And it's those private equity fund commitments that really make our business quite unique, in that they provide us with a tremendous amount of knowledge and research regarding those private equity sponsors. And obviously, in many cases, we sit on their advisory board and those relationships. It also provides us with a capability to really be a one-stop shop, exclusive provider of capital to the middle market. And the business has grown very dramatically over the last several years. In fact, in 2020, we raised over $6 billion of capital for our business. And we actually invested a little over $6 billion in U.S. private companies, in over 200 companies, which ranked us as one of the top 3 direct lenders in the United States.
So as we sit here today, what do you see as the opportunity in the middle market private credit space?
Well, it's an interesting time. You know, back in early 2020, we were actually quite active in the first quarter. And when COVID hit, I think all of the direct managers spent a lot of time focusing on addressing the liquidity needs of their portfolio companies, working with their private equity sponsor relationships to make sure that those companies were well positioned to deal with what many expected was going to be a long-term issue. But in fact, it turned out to be a very different type of recessionary dynamic than we've ever seen. Unlike the GFC, which was a pretty much across-the-board impact, this was very much one of kind of the haves and the have-nots. Certain industries were very, very severely impacted. Fortunately for us, they were generally industries where we did not invest. So areas like oil and gas and travel and leisure, restaurants and retail were all very severely impacted. But historically, we at Churchill have not been an investor in those areas. So in many respects, the COVID-19 crisis, from an investment standpoint, kind of helped validate our thesis of investing with more traditional companies not in those areas more heavily affected. I think the big surprise for all of us was how quickly things rebounded. And in fact, by the fourth quarter of last year, we were seeing significant activity. And in fact, the private markets saw a record quarter in the fourth quarter, and we, Churchill, saw a record quarter of investment activity. And fortunately, it was generally with companies that were not COVID impacted, businesses that were doing quite well, or certainly maybe even thriving through COVID, and sponsors were paying high purchase multiples, so we were seeing significant equity, generally lower leverage for companies not impacted by COVID. So the fourth quarter was really kind of the optimal conditions, if you will, and we were quite active. Things have continued into the first quarter. If you look at the pricing today, it sits still better than we saw roughly a year ago, pre-COVID, and interestingly enough, significantly better than the liquid markets. We're seeing a wider premium today in the middle market lending space relative to the BSL, the broadly syndicated loan market, upwards of some 200 to 300 basis points better than the liquid loan market. So still a great time to be investing. All of our loans, as I think you know and our audience knows, are pegged off LIBOR, so they are in effect inflation protected in any rising rate environment, offer natural hedge against rising rates. A lot of equity being contributed, so generally good conditions to be investing, and certainly the outlook over the next several quarters, indeed over the next year to two, is looking quite good for the overall economy. So I think we're going to see a very attractive time to be investing in private credit as the economy comes out of COVID and people get back to work and back to traveling and doing other activities. I think that's a good thing from a standpoint of an investment.
So given this current market environment, what are some of the competitive dynamics that you see for credit managers, for the investment opportunities that may be out there?
Well, I think, it's interesting in COVID. What we've seen is the characteristics that were important for managers historically are probably even more important today. So I would say the two key drivers that continue to really drive our market are really relationships, differentiated sourcing, if you will. How do you drive sourcing of opportunities? And if you have a long history of relationships with private equity firms, we've been investing now for 15 plus years in private equity owned businesses and providing financing to those companies. We've completed over 600 transactions in our history, so we are very close to all the most active private equity firms in the market today, having done dozens of transactions with them. So we have a long history with those firms. We have a history of consistently delivering solutions to those firms, so we're very reliable. We have a business model, as you know, that's very flexible, and most importantly, as it relates to the private equity relationships, we are a significant limited partner in over 150 middle market private equity firms. We sit on the advisory board of well over 100 of those firms, and that really serves to drive tremendous deal flow, but it also provides us with a lot of understanding of what industries they're good at, their track record, their history, and helps us to drive our investment toward the firms that have actually historically performed well. So relationships. And then secondly is really scale. It's the ability to deliver not just a solution, but a solution that's viable for a sponsor that may be looking for 100, 200, 300 million of financing. So today we can commit to over 200 million per deal. We have obviously the benefits of being part of the larger TIAA organization, which, as I'd mentioned earlier, is the largest investor in private equity.
So to summarize or to wrap up, what are some of the things that an investor should look at when it comes to selecting a manager? What are some of those factors that one should think about for picking a successful credit investing investor?
Sure. So I think today, if I guess you're asking me if I'm an investor, right?
Yes,
and I'm
exactly.
looking at key criteria I would look to see in a private credit manager today. Well, first and foremost, I think you have to look at track record, right? You've got to look at how long have they been investing together. In Churchill's case, we've been investing together for over 15 years. We've invested over $16 billion together as an investment team, unanimously approving every investment. So strong track record through cycles, right? Through the GFC, through COVID. How has that strategy performed? So I think that's number one in anyone's book. You look at the nature of the team, the experience, and not just the investment team, but the infrastructure and the resources that firms support those teams with in terms of operations, finance, investor relations, answering investor questions, really being there to support the investment process and the investment experience of working with that manager. I think number three, and I think incredibly important as well, is the fundamental approach to investing. What's the investment strategy? Is it focused Is it consistent? Has it been successful through the cycles? And by that I mean things like, is there a focus on a high level of selectivity, right? What percentage of the deals that they see do they actually do? And so high level of selectivity. What's the approach from a diversification standpoint? Are they diversifying their portfolios significantly? Is their target hold 1%, or is it a willingness to do 4, 5, 6% of a single investment? We believe diversification and selectivity are key hallmarks of the way that we invest, and I think that successful managers recognize that by diversifying their portfolio, they are going to be able to avoid the inevitable issues that might emerge by having such a diversification of the risk through their portfolio. So I think that is, in many respects, the third most important dynamic. And I think finally, I would say it comes back to the two things that I've mentioned as being competitive dynamics. Differentiating sourcing, a differentiated strategy for sourcing. How do you drive deal flow that puts you in a position where you're not simply competing on price, right? I mean, anyone can source a deal if they're willing to be the lowest price and have no covenants and no terms. So you need to be able to drive significant deal flow that allows you to be selective and turn down opportunities that may be a great company but a poor structure, or a great structure but a poor company.
Yes.
And I think going with that, as I mentioned earlier, is the scale of the platform. And I think that today's market is really defined by the largest players having the scale to provide the solution that ultimately drives, I think, better outcomes.
You've mentioned differentiated sourcing. You've mentioned the importance of scale. How is the TIAA relationship? Has it been helpful to the business?
That's a great question, Gene, and I'm glad you raised it. It's been extraordinarily helpful. I mentioned the LP relationships, the fact that TIAA is one of the largest investors in private credit. They're also one of the largest investors in private equity funds themselves. So we have a wealth of relationships to really help drive deal flow. And I think equally as important, allowing us the research, the access to the data, the information to really support our decisions to work with various firms. The fact that they have a strong track record across the board, the fact that they generally have good relationships with their lenders, the fact that they have certain industries where they have particular expertise. So I think the TIAA LP relationships, the investments in those LPs has been very helpful. The other area where I think it's been extraordinarily helpful is with our investors has been, and I think, I certainly think is important as they make a decision to invest with us, is the alignment. The fact that TIAA today has, in our senior lending strategy, over $4 billion invested directly alongside our third-party investors. And in fact, TIAA invests about a third of every single deal that we do with our investors. So we have a tremendous amount of capital, skin in the game, if you will, and alignment with our investors that in many respects is quite unique and differentiated. So, a lot of private capital managers might have a modest investment as a GP in a fund, but our relationship and our alignment goes much beyond that to include a significant commitment in every single investment that we make.
That's great, Ken. Thank you very much. And thank you all for letting us spend some time with you this morning.
Thanks, Gene.